good morning, good afternoon, everybody, depending on where you're at. How the heck are you? Let us get a chat open here and somebody tell me if you've got audio. Kevin, how you doing, buddy? Trip, good to see you, my friend. Confirm audio for me, please. All good on audio. Thank you, thank you, thank you. Yuri, how you doing? Good to see you there. All right, my friends, let's get going. The first thing I wanted to do is segue. You know how on your photos, well, at least on mine with Google Photos, it just randomly pops up. It says 1 year ago today. And I'm looking at this going, holy cow, was that a whole year ago? This is down in Mexico 1 year ago. This is a beautiful little place that I found that was a 1.5 mile walk from my hotel. It got to the end of the beach. You can see from there, it goes into the jungle. And right at the end, it had this beautiful little cove. It was pretty awesome. Confirm for me, you can see what I'm showing you. No video. Just me, just the pic. Okay, well, let me do the screen share. And there you go. How about now? Ah, very good. Okay, so that was this, it goes right into the jungle, and it was just this gorgeous little beach. Turn around, look back the other way. See, the hotels are like 1.5 miles back down the other way. It's pretty amazing. And this thing would change. I went there several mornings. It would change every morning. The sand would either be a lot higher or lower, but it was just this gorgeous little alcove. And we did a lot of fun things there. That is the longest zip line in Mexico, they say, and it goes from this huge tower all the way down right into the forest and all the way down to the forest floor. It's kind of fun to go Superman. And went diving, loved to go diving, and saw some cool stuff. And anyway, it was just kind of fun to reminisce. We went to a cenote, and a cenote is where you get wet. But let's see. There you go. That was one of the funnest things. They had this diving platform to drop into a cenote, and you can see me there doing it's called a penny drop. And when people haven't seen it, it's kind of cool because it freaks them out. You jump up and you go face first, just flat like that. And right at the very end, you just squeeze your hands to your feet, and you make kind of like a pennant shape, like a diamond, and you just drop in. And it's not brutal, but man, it makes everybody think that you're doing a belly flop from 15 feet or 20 feet or whatever it is. It looks just like a belly flop. And you just drop in the very last minute. You go plunk, you pinch up and drop in. Yeah, it's pretty fun. Were there a lot of bugs? No, I didn't see a lot of bugs there at all. It didn't bother me. There wasn't anything there that bothered me at all. So anyway, let's go back, and that's my granddaughter. Anyway, it was just fun to kind of reminisce and launch back there. Let's do the stop sharing on this and go right to our slides this morning, shall we? All right. So let's screen share over to the slides. So guys, I used kind of a funny title, a provocative little kind of a title. And the idea, we're going to talk about wedges today, not literally wedgies, but wedges. Let's see. So we're fully recovered from our last COVID issue. Yes, we are. My wife is fully recovered. She goes off of her blood thinner medication in about a week. And we're both fully recovered. We're back down in California right now, actually. And there is one thing that I think I will show you. let me back up here. Last night, good grief, hang on. What is it doing here? I just want to show you what I'm doing, what I'm working on down here. So let me do this. We'll do this screen share over to come on now. That's what I want to screen share for you. Let's see if I can find that. There we go. Okay. Can you see the little project here? Yeah. Yeah, so that's the little dome that I'm building here. I've got 7 weeks into it, and it is it's pretty fun. I should have taken pictures before I left on the last night on the inside, but to give you kind of an idea, we're getting close. We're down to finish stages, and it's sure been a lot of fun. Oh my gosh, it's been a lot of fun, and we are rapidly running out of time. Let's see if I can get back and show you an interior shot here. We're running out of time, which is kind of sad, but we're going to have a family reunion back here in June. And so we'll come down about a week early and do the finishing touches so that we can use it during the family reunion. But this is a picture of the inside. It's kind of dark last night, but that's the kitchen wall and little kind of 3/4 size refrigerator, and the range goes right there, and then there's counter space to the right. There's a loft. You can see the stairs going up to the loft, about 400 square foot loft, and it's been such a fun project, just fun project. We're about 200 yards back in the woods up a little gravel road, very isolated, completely off grid. I've got 100% solar power, tons of power. We'll be on propane and solar, and totally disconnected from the grid, as they say. So anyway, that's what I'm doing here. And we go home next Tuesday. Back to our wedges now. All right. There we go. Guys, pay attention to the calendar, things coming up. There's a lot of things on the schedule. Rob blows me away with his ability to put new product and new content out there for you guys almost every day. Huge effort on his part. Really appreciate it. We've got a couple things coming up. Trading the Gap. Rob's got a session, Trading the Gap, coming up. And this is it. This is interesting. This little crash course that Rob's put together for kind of beginning trading, kind of step-by-step process of making sure that you don't step into landmines. And I really appreciate the way he does that too, by the way. All right, so here we go. Now I've got the text chat open so that I can see. I want you guys to participate in this to whatever degree that you want to, but don't hesitate. I like getting input. Doesn't distract me at all. I feel, excuse me, that I even teach better that way when it's interactive. So let's talk about wedgies. I call them wedgies. It's just a little play on word, obviously, but wedge patterns, what are they? Whether it's a classic wedge or it's a bunch, which is just a real tight compression. Wedges are, it says more senses engaged, more retention. Okay, good, cool. I really appreciate that. When when you look at a wedge or a bunch pattern, what you're seeing is price compression. That's all. When the market is all completely agreed on a price, the price doesn't move. You understand that? If everybody agreed on the price would not move. It would be static. Price movement comes when you have buying pressure and selling pressure that are not in balance. That's all it is. If you've got buying pressure, you've got more buying energy than there is selling energy. Now, there's always the same number of buyers and sellers. I mean, you can show orders where there's people lined up to buy and people not lined up to sell. You say, well, there's more buyers than sellers. Well, that's garbage. That's garbage. It's absolutely, there is never a situation where there's more buyers than sellers. Now, I immediately, you're going to want to argue with me just based on logic. And I'll cave on that just a little bit. At any point in time, they may look like there's more buyers than sellers. There's more people waving their hand going, I'll buy, I'll buy, I'll buy, than there's people saying, I'll sell, I'll sell, I'll sell. But guys, the only reason, I mean, everybody's in the market to either buy or sell. And the only reason there may be an imbalance of buying pressure or selling pressure is that at the moment you're at the wrong price. You got a bunch of people saying, I'll buy at this price, I'll buy at this price, I'll buy at this price. And there's very few people going, I'll sell at that price. Does that mean there's more buyers and sellers? No, it does not. It means at that price, you've got more people willing to buy than willing to sell at that price. But it's not like the sellers aren't there. Change the price and watch what happens. If you reach an equilibrium, you have equal number of buying and selling going on as far as pressure, but the price doesn't move. Okay. Now, if you have a strong buying pressure where there's some kind of a panic in the market, you may have people willing to buy at higher and higher prices, which will draw out sellers that will go, sure, I'll sell it at that price. Now you've got equal buying and selling pressure, but the price is going up. Okay. So whenever you have wedges, what you have is you've got a compression on the price. That's it. You may have more buying or more selling pressure, or you may have equal. That doesn't matter. Look at what the price is doing. Guys, I have been such a strong proponent for so many years of throwing convention out the window. I hate market maxims. And I say that tongue in cheek because I've written about 20 of them. And if they're good and accurate, that's great. But the market maxims that say, oh, when you see this pattern, you do this. When you see that pattern, you do that. That is garbage. That is so rarely accurate. And I mean it, so rarely accurate. So when you see a market maximum that says, oh, this is this pattern, this is what you do. It's the same thing with, guys, I learned this with candlesticks more probably than anything else. Because my contribution to candlesticks, one of my contributions to the art of candlestick trading, was the ability to say the convention is wrong. There was no data to support all of the statements that were out there by Steve Nissen and the early proponents of candlesticks. There was no data to back it up. Oh, this is a good pattern. Really? What's good? Define good. Well, it's good. Show me. What does that mean? What does good mean? And they couldn't do it. I said, is it 50% accurate? Oh, it's more than that. 70? Oh, it's more than that. How much is it? Well, I don't know, but it's good. See, and then it starts to break down. You pin people down and you find out, you know, they say, and I love it, it says you don't know who's swimming naked until the tide goes out. And it's true. And when you press people on something, they either can back it up or they don't back it up. Okay. They either back it up or they can't. And if they can't, well, then you've got a market maxim that doesn't hold water. You know, it doesn't work. So patterns, wedges, I love them as a pattern because they can be very helpful. But if you don't have the context, if you don't have the right rules, it's just noise. I don't care who says it. It's just noise. And I'll prove that to you here. In fact, I'm going to jump right to the end, just because, I mean, I like doing this when it's relevant. And right now I'm going to do this as a relevant here, because we're talking about this. All right. Last week, we had the announcement in the market that we were having a death cross. Everybody know what a death cross is? Give me, a couple people give me some feedback. Either say, no, I don't, I missed it last week. It was all the talk for a couple of days. Okay. Yep. Robert says, yeah, I saw it. I heard about it. Yep. Okay, cool. So what the heck is a big deal? Is a death cross a big deal, Donald? Do you know, Debbie, is it a big deal? When the short-term moving averages cross the long-term moving averages, is it a big deal? Erica Scott says yes. Says who? Now, Erica, I'm not picking on you. I want to engage with you here. Okay. Who says it's a big deal? Robert says it's not a big deal to me, and that's good. Guys, I put all the information right there for you to look at. If you're glancing over it, you better be careful if you say it's a big deal. It's a big deal to CNBC. It's a big deal to everybody, MSNBC. Anybody who wants to fill time, they have to have some content. They have to have something on their screen or you won't watch, or they have to have something to talk about or you won't listen. Okay. So what is it? Well, it's supposedly a big deal. But here's the reality. Has it been accurate? Yes, all major downturns have had a death cross. Duh, come on. In order to have a major downturn, your short-term moving averages have to cross the long-term moving averages. They have to. So what? So it's going to be accurate every time there's a long-term downturn. Yes. So let's look at all the death crosses since 2006. 2006, 2007, 2008, 2010, 11, and 16. Okay. How many of those were followed by a long-term market downturn? One. Really? No, I'm kidding. It wasn't even one. I mean, in only one case was the market negative a year later, and that was 2007, 2008. Okay. So we had a correction. But guys, that's one out of the last 6. I wouldn't call that significant. I wouldn't call that, earth-shaking. Okay. Does that make sense, guys? It's just, you have to have context. Robert says, looks to me like people are putting too much significance. All it is they need something to talk about on freaking CNBC. They have to fill up the time. Now, this information is not hard to find. Did anybody hear last week on MSNBC, CNBC, Bloomberg, any of the business channels? Did you hear any of them tell you what I just told you? That it has only been accurate 1 out of the last 6 times. Did anybody hear that last week? Not one, Robert says, not one, exactly. But is it true? It's absolutely true. And you see, I mean, you can say, well, it is accurately predicted all of these major downturns. Exactly, it has to. It has to be a part of it. By definition, it has to. But every time it happens doesn't mean you're going to have a negative market reversal. Okay. So the bottom line is I hate this convention of this mind think, this group think that you can't back up. Guys, the Santa Claus rally is one of the biggest jokes. They've made 3 different definitions of the Santa Claus rally, 3 of them, to try to explain what actually happens. How accurate is it? What about the market? The reshuffling of the deck in all of the portfolios at the end of every year or starting in October. Yeah, it happens, but it's not so consistent that you can bet on it. Okay. Michael says, couldn't you say that after 6 death crosses, 5 of them resulted in higher market? Guys, it is more accurate as a contrarian indicator than it is as a predictor. It is. It's more accurate as a contrarian than it is as a predictor. It's 100% accurate if you have a major market turndown, but it's more accurate at failing to predict it. That's the beauty of statistics. You can twist things and make them sound or say anything you want. It's crazy. Anyway, let's get back to wedges. Erica, who I engaged with to the start on this thing, maybe not thought indicates the market is headed towards a turn to bearish. Well, you can stretch it as hard as you want, Erica, but the fact is, it isn't very accurate. The irony is it's 100% accurate when it's right. Guys, think about that. That's all it boils down to. It's 100% accurate. Oh my gosh, I better pay attention. It's 100% accurate when it's right. How often is it right? Not very much. But it's 100% accurate when it's right. Oh, it's hilarious. Hilarious. All right, here we go. Guys, hang on just a second. I've got oh my gosh, I've got somebody. Hey, this is Ryan. Yeah, I'm in a class. I can't talk to you until 10 o'clock. Are you going to be here?
Oh, that's what I was wondering. Can I stop by a quick couple of 20 recordings about there on my way? Or
No, I won't be there till 10 o'clock. Okay. But I got to get back to my class.
if there'll be enough time to work today?
Let me talk to you at, yes, but starting at 10 o'clock. No more. You're later than that if needed. Okay. Thanks. I'm really sorry, guys, but I'm in the middle of this project and I've got this fellow that is bringing some stuff to me, and that's horrible. Mea culpa. My bad. All right. So let's talk about wedges. And this is actually easy because everything that we talked about is super relevant to what we're going to talk about here, to understanding wedges. Why? Because there is so much that's associated with them that it, again, is maxim related, and you have to put it in context. And I can do that, guys. I can put this in context so that you will have the tools to understand wedges and how to use them and when to lean on them, when not to lean on them. So let's talk about classic patterns. Okay, here we go. Wedges. It's price compression. If you have a pattern where a stock is moving higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, that's called what? That's called an uptrend. Okay. And if the move on the upside and the downside are the same, then that uptrend just continues forever. It's a beautiful thing. But the reality, the world we live in, is that that doesn't happen forever. Patterns tend to go, how many times, guys? Somebody tell me, how many times do patterns tend to, again, I'm skating on the edge of convention, but there is an actual range that you should have. 3 to 5 times trip is right on. It's 3 to 5 times. Okay, don't say 5, don't say 6. That's not true. 3 to 5 times is pretty true. Can it go more? Yes, it can go more. But until you get 3, you don't even have a pattern. So 3 to 5 is typically what happens. What happens is this. Look up here at the top. You can see my cursor up here. The tops keep getting higher, or in this case, lower. The bottoms are holding level. Okay. Here, the tops are the same and the bottoms keep rising higher. Here, the tops are coming down and the bottoms are coming up. It's still a pattern, but in this uptrend, the bottoms are coming up, but the tops aren't. So if you had a trend, you would have higher highs, higher lows, higher highs, higher lows. As soon as you stop throwing higher highs, but your lows keep going, now you're starting to form a wedge. It's a trend as long as you have higher highs, higher lows, higher highs, higher lows, or lower highs, lower lows, lower highs, lower lows. That's a trend. As soon as one of those components quits following that, the bottoms in an uptrend can still keep going. The bottoms are going up right here, higher bottoms, but the tops are not going higher, and that's causing a price compression. Okay, that's a price compression. That's what a wedge is. And a classic wedge is either tops coming down with bottoms level or bottoms coming up with tops level. That's a classic wedge pattern. Then you have the pennant, where the tops are coming down and the bottoms are coming up. Now, that's a pennant, a pinafore type of a shape there, where the tops are coming down, the bottoms are coming up. That's a wedge pattern. Okay. So those are your classic wedges. Now you have variations on the theme, and we'll talk about those variations in just a minute. But there's a general rule that I want you to put into your mind, and it's something to look for. Is it 100%? No, it's not by any means, but it's strong enough to watch for. And that is patterns in wedges tend to break 2/3 of the way into the pattern, about 2/3 of the way in, 2/3 to 3/4. The truth is, if a pattern goes all the way, to the end, in other words, if it trades all the way down like this one is on the bottom right to a pinch, all bets are off at that point. The most common thing is it dribbles out or it dribbles up. In other words, if you squeeze something until it pops, you get a release of pressure. You squeeze a balloon, you can squeeze it down, and then it goes pop, right? Wedges tend to do that, but they tend to do it about 3/4 of the way in, 2/3 to 3/4, and then they release pressure. If you squeeze it all the way down to where it's squeezed down to almost nothing, it's like all of the air leaked out of the balloon and there's no pressure there, and it dribbles out or it dribbles up. There's usually very little pressure when it trades down like that. It doesn't come out of them strong. But if it comes out at about 2/3 to 3/4 of the way in, it tends to be a pretty strong reaction. Okay, those are the general rules. Now, let's talk about the bunching. A bunch is a wedge pattern. It's where the price simply gets stuck. It gets stuck. You might be moving sideways, you might be moving up, you might be moving down. Now, when it bunches, when it gets stuck, what does that mean? Be careful as you answer this. I am setting you up. Look at this one over here. What does it mean when a price just bunches out? Will, I'm going to draw out anything you want here. I've got some time set up to do that. But what does it mean when a price bunches? Anybody? Pressure, indecision. Okay, those are interesting terms. I agree with the idea of pressure because that's what it looks like. But what is really going on? Is it really indecision? Consolidation. Okay, consolidation. That's a good word. Good. I'm gonna ask you, is it really indecision, or could it be the opposite of indecision? Remember what we started talking about. Remember what the very first thing that I started talking about? Balance. Yeah. Could it be that everybody is agreeing on the price, Karen? Could it be that everybody is in agreement? We have equal buying, equal selling pressure, and it's all at the same price. There's another correlation. Tripp says, like catching your breath after a sprint. Yeah, if you've been moving up with strong buying pressure, it may look like stopping to catch your breath. Okay, Cool. I agree. It may look like that, but is that really what's going on? What it means is that the buying pressure that drove you up to this point is gone. And now buying and selling is equal. It's an equilibrium. Thank you. Yay, there's the big word. Thank you, Trip. Guys, it's an equilibrium. Price is fine. Everybody's agreeing on it. Now, the people who like to drive the price up or down, the directional traders, they're not happy with this. But what you have is a price equilibrium. Everybody's okay with the price. Who likes it here? Guys, portfolio managers that are moving stocks around like it like this because the price stays stable for several days or weeks or minutes, in fast day trading in indexes. The price stays level long enough to move some money around, to take positions, to close positions. So money managers and position traders, they kind of like this. But all it means is you have equilibrium. It's really not indecisive. It's not the market tired, can't catch its breath. That's what it looks like. And we can make those analogies if you want. That's fine. I don't have a problem with that. But you need to know what's really going on. What you have is an equilibrium. You have equal buying and selling pressure at the same price, and nobody's challenging that. Okay. So what does it mean? It means nothing. Nothing is either good or bad except by comparison. Jot that down. I've said that before. If you didn't write it down, please write it down now. Nothing is either good or bad except by comparison. Oh, that's a compression pattern. Yes, it is. What do you do with that? Well, no. The only way you can tell me anything significant, the only thing that you can tell me significant about bunching is if you can show me backwards, which is what I'm doing here with my cursor, is if you can look back over the last 6 months, you can say bunching lasts for, let's say that's 2 weeks. When you get about a 2-week compression, boom, you get a big pressure release, up or down. I don't know. Yes, up or down. Oh, isn't it always up? Nope. Is it down? Nope. It just releases pressure and it moves. Okay. How big are the moves? Well, you count it up. If this is a 10, that's a 5. That's a 8. That's a 9. That's a 6. That's a 10. Okay, so you have a 5 to 10 point move after about a 2-week compression. See, now you could write a rule for this particular stock index, whatever it is you're trading. Now you can tell me it's impressive. You can tell me it's consistent. You can tell me there's a rule and I'll believe it. Now, is there a guarantee? No, but it's certainly worth trading now because I'm looking at 5 to 10 point move after about 2 weeks. How long has this last compression lasted? Oh, about 2 weeks. So if it breaks out, I will be looking for a 5 to 10 point move, up or down. Yes. I don't know, but it'll be one or the other based on the pattern. If you can show me there's relevance, there's relevance. But this one up here by itself, is that relevant? No. I can tell you what it is. It's price equilibrium. Well, what do you do with it? I have no idea. I have no context. I got nothing. Oh, that's a wedge pattern. What do you do? Well, you trade it when it goes to here and no. What stock are we trading? I don't know. Well, then you don't know anything. There's nothing to show you that pattern will do anything. Nothing. Yeah, but it's a wedge and I read about, I don't care what you read about. Well, so-and-so said, I don't care what so-and-so said. Unless you can put some context and show me the relevance, it means nothing. Just like the stupid death cross. It's 100% accurate when it's right. Big deal. What does that mean? Nothing. Nothing. Yeah, but it's a death cross and it's been 100% right when it's right. Yeah. So what? Am I making sense, guys? Do you follow it? I get a little bit passionate about this stuff, but I hate BS and I hate, stuff that people just swallow whole. All right, so let's talk about related patterns. When I look up wedges, the vast majority of the examples I show are in trends. Okay. They are not the classic wedge patterns. This is the classic wedge patterns. Tops coming down, bottoms flat. Tops flat, bottoms coming up. Pennant, top coming down, bottom coming up. Those are the three classic patterns, and they happen a lot. They really do. But this kind of stuff is what you see drawn out. And here it gets a little bit funny, because is this really a wedge? Yes, it's the forming of a wedge, but it's a trend. This is an uptrend where the tops are just not getting higher, or they're getting less high and less high, but the bottoms keep rising. There's the wedge. The wedge is at the end. And guys, I see this drawn wrong all the time. I see this getting drawn wrong incorrectly, because they're drawing this whole thing as a wedge. It's not. This is a trend. It's starting to wedge when one of the two factions, or the two definitions of an uptrend, is you have rising tops and rising bottoms. If one of them starts to fail in an uptrend, it'll be the top. If the tops stop rising as much, that's normal. That's because the patterns go 3 to 5 times and break down. Guys, you see how it all fits together? I hope you're starting to see this fit together. Patterns go 3 to 5 times and they break down. How do they break down? They almost always break down in a wedge. What's driving this pattern is bullish buying pressure. Higher highs, higher lows, higher highs, higher lows is a function of having an imbalance. You have buying pressure. As Tripp says, you can get tired. The buying pressure eventually runs out. And that buying pressure to drive higher highs and higher lows will usually manifest itself with higher highs, but not quite as high. And then another high, but maybe not even as high as the last one. But the bottoms keep rising. That is the compression into the wedge. That is price starting to look towards an equilibrium. If you are still bullish, now listen, this is so good. If you are still bullish, it will go about 2/3 to 3/4 of the way in, and then break out and continue the trend. If it's still bullish, it will continue the trend. If it is not bullish, it will break down, and then you look to the left for targeting, and it will drop until it finds an equilibrium. In a downtrend, lower tops, lower bottoms, lower tops, lower bottoms. And what happens is the bottoms keep getting lower. Excuse me, the tops keep getting lower, but the bottoms start leveling out or getting smaller. And then it starts to form a wedge. But the whole thing is not a wedge, it's a trend. And you're developing a wedge at the end of a trend. And it's either going to be the end completely of that trend, and it will reverse directions, or it will simply, as Tripp was kind of indicating, you can use the analogy of it's getting tired, takes a breather, and then it takes off again. Just needed to rest. Give me a drink, and I'm here. I'm going again for the next round. Here we go. Okay, that is a classic kind of reaction. But it is wrong to draw the whole thing as a wedge. It's not. It's a trend that is now starting to wedge as the trend matures 3 to 5 times. Got it? A trend going 3 to 5 times will collapse, and usually collapses in a wedge type pattern. That's the way it should be interpreted. That's the way it should be taught, because that's really what's going on. Okay. Now you have head and shoulder patterns. Are they wedges? No, but they can start looking like wedges. A head and shoulder pattern is a price compression. It's a strong bullish one. I've shown you here. A classic one is shoulder, then you head in the middle, and another shoulder, and then it breaks down. That's a reversal pattern. But what if you have a shoulder here on the second one, then you have the head, then you have a higher shoulder? Well, then the neckline is pointing up. And now this is not as likely to reverse. In fact, oftentimes this will compress into a wedge and then break out to the upside and keep going. So this is, again, a natural resolution to an uptrend where price starts to compress. And depending on the shape of it, depending on how long it lasts, it will have a tendency to break to the upside or a reverse. It's going to do one of the two. it typically is going to reverse, or it's going to break out to another leg up, or another leg of the trend up, which would be a 3 to 5 times pattern repeat. Okay. All right, guys, we got about 10 minutes left. Then we have flags, bullish and bearish flags. These are called wedges, but they're not really wedges. In an uptrend, you will suddenly reverse. See my cursor down here on the left? In an uptrend, you'll reverse and you'll start throwing lower tops, lower bottoms, lower tops, lower bottoms, lower tops. And you get about 2 or 3 reiterations, and then it breaks back up and keeps going. All that is a pause. It's not really a wedge. It's just a pause. It's a reversal. What if it looked like a pennant? What if the tops came down, the bottoms came up? Same thing. It's just taking a break. And then they'll either consolidate at that equilibrium for a little bit, and then the price will take off to the upside, or it'll break down. That's it. That's all. In a strong bullish trend, when you go into a price compression, you are going to get some kind of a reaction, either break out to the upside and keep going, or breakdown of the pattern, or reverse. And you see the reversal. A bearish flag is where it's moving down solidly, then suddenly there's a fight back to the upside. It compresses or not. In this case, it's just a little, this is a classic flag, but you could throw a wedge right there, and they're going to be very related to each other. You're going to look for the same kind of movement or behavior on that. Okay. All right. So now I'm pulling up just some classic pictures of different types of wedge patterns right here. And what you'll notice is, I'll just take these one at a time. In fact, what I'm going to do is I'm going to change my sharing, and I'm going to go over to the PowerPoints themselves, because this is what Will was talking about. And I want to do a little bit of diagramming here, annotating. Is that the right one now? There we go. All right. And can I move this out of the, yes, I can get that out of my field of vision. All right. So now look at this one on the left. You're driving down. It reverses and it goes up, higher highs, higher lows, higher highs, higher lows. But that range of motion, the highs or the rallies are getting smaller. So the bottoms are still coming up, but the surges are collapsing. That's what's creating this wedge type of a pattern. When that breaks down right here, when that breaks down, you look to the left for a target. This rally point is the target. So if you were looking at this, your realistic trade would be that many dollars. Could it go more? Yeah, it could go more, but this is what you should be looking for. That price drop right there would be what you would be looking for. Okay. I've changed pen color. Well, I don't want to do that either. I'm keep picking ones that are, yeah, I guess we can stay with the blue, but nope. I'm going to go chartreuse. There we go. All right. Now this wedge is drawn kind of incorrectly. This is really what's going on. Here's your price consolidation. These tails show a major reversal 2 days in a row. Then you come down and close on it. What is this? This is an exploratory move down here to see if there's anything below. There's nothing. There's no buying. There's no selling pressure. They give up on it. It comes right back down, and we settle on the same price, and we launch. So I'm going to say I just copied this picture because I wanted to argue with it. Whoever drew this line is wrong. They're wrong. That's not what was going down. Yes, those are closing prices, but they don't line up. That red line is a stupid line. I'm sorry, it's a stupid line. The good line is my nice chartreuse one. Okay, because you have 2 days where you reached down intraday and buyers came back in on the same price. You came down and you closed by touching that same price. The next day you send a party across the line to see if there's any selling pressure on the other side of the line. You find out, nope, there's not. What does that tell you? Well, this is a good price. So twice you've established that price. So it rallies back up, comes back down, stops again, tests the same exact price, and then takes off. That makes perfect sense. And what do you have? Tops lower, 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 bottoms level, 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 classic, break to the upside. Where's your target? Target is right here. That's the target. Where does it go? Boom, right there. So the trade was for this many dollars and you got it. Then it does what? It does a bunch. There's no pattern up here. You have 1, 2, 3, 4, 5, 6, 7 days at basically the same price. You got a bunch, you got a knot, you got a bunch right there. Now that's either going to break down and the pattern will be sent back here to this lower target, or it breaks out to the upside. In this case, it broke to the upside. Anything predict that? Not necessarily. Not necessarily, but it did exactly what it was supposed to do in terms of if it follows a pattern, this is what it will do. And guess what? It followed the pattern and it did it. Now, show me that it does that 3 or 4 times, the last 3 or 4 times, then I'll believe and say next time this is exactly what we're going to do. Other than that, you just have to play it by if it does this, then the target will be there and I'll play that. If it does that, then I'll do this. It's that simple, guys. It's not really complicated, but you have to have relevance. You have to look back to the left to find relevance. If it's not there, it's not there. Don't force it. If it's not there, it's not there. Okay. Now this, for crying out loud, guys, what is this? This is an uptrend. Yes? Well, sort of. That's your wedge. Again, whoever drew this, they are wrong. They're wrong. This is the wedge. And I've got a vanishing line. I didn't want that. I just want a regular pencil. There it is. Let's try it again. That's yay. This is the wedge. You see how all the tops are the same for 3 iterations? 1, 2, 3. It's a rising wedge. And what does a rising wedge tend to do? Well, if you go through 2/3 to 3/4 of the way in and break, then it does something. What happens if you go all the way in? You dribble out. What happened? And then it gives up. Okay. It dribbles out because it went too far in. Okay. But again, the wedge is drawn wrong because this is exactly what actually happened. And when it came out of it, it just kind of dribbled, it kind of did this and went, yeah, I got nothing. As opposed to this one where you blasted. Okay, did it dribble out? No, it didn't. So, do we have a rule? No, we don't have a rule. We have a tendency. That's it, guys. These are tendencies, and that's all you can put into it. And what you do is you look to the left and say, how did it behave the last 3 or 4 times it did this? That is your single biggest indicator of what is going to happen, is what did it do the last 5 or 6 times it did that? Okay, let's go do this again. Let's look at this one. We're in a downtrend right here. It breaks out. You could call this a flag pattern. 1, 2, 3. If it follows the normal pattern, this will follow the reversal down. Trading into this wedge, if it drops to the, if it pushes back to the upside, it's going to immediately run into some resistance right here. If it follows the pattern, that's what it'll do. Those are your 2 options. Stronger option, more likely, is to break to the downside. I'd play this on a downside break. Okay. Again, if you look sideways here, guys, look at how many times these tails found this price. This is the way this should be drawn. It's not drawn correctly. I mean, look at those red lines. They really are not doing anything other than kind of approximating but they're not following anything. What is the starting point for the red line? There's nothing. There's no starting point. What is it starting off? Well, it's off a closing price. And then it goes to tails. Well, if you're going to do closing prices, do closing prices. Look at this. That is the wedge. 1, 2, 3, and boom, away you go. All right. Again, looking at this one right here. What is it? If you don't recognize it, guys, this is the same chart right here. This one just shows the actual breakout, the one on the far right. This shows compressing into it. So this is a bullish flag, if you will. Boom, boom, boom. If it breaks, then you would look for a continuation up here because it would continue to follow whatever that bullish trend was. That would be your target up there. Your first resistance would be right here. The second target would be to resume the trend, which is back up to the top of the trend line. Will says, is it a flag or a pennant? On this one, I would call it a wedge. You know, it's a descending wedge. Tops are the bottoms are level, the tops are coming down. You'd have to twist it a little bit to make it a pennant, but the next question is, who cares? Will, a flag, if you want a classic drawing of a flag, looks like that. A pennant is going to look like this. And a wedge is going to look like that. So what? There's no difference. The rules aren't any different. All it is a price compression after a bullish run. You're reaching equilibrium and you're going to find out if there is still buying pressure. If there is, it'll take off and the bullish trend will continue. Trend mean higher tops, higher bottoms. You got it, Will? It doesn't make any difference. Whether, and it doesn't make any difference if you call the pennant a wedge or if you call the wedge a flag, I don't care. As long as you recognize what's going on right here. As long as you recognize what's going on, you're golden. I don't care if you get it wrong. You know, somebody can argue, oh, you said the wrong word. So what? I made the right trade and made $1,000. Well, how much did you make? Well, but I got the pattern name right. Good for you. Entry points can be different. No. Yes and no. Will. Entry points can be different. Not really. You're going to play this when it breaks out of the pattern. What's the pattern? It's a flag, which is a little mini trend. It's a wedge. It's a pennant. Where's the breakout? It's exactly the same. You play it when it breaks out of here, when it breaks out of here, when it breaks out of here, if it's a bullish trade. Okay? When it breaks the new little compression pattern, that's when you trade. Guys, it's that simple. Okay. All right. So, well, that was fun. I didn't erase all my marks off of here. And let's see. Crap. Now I can't get back to. Anyway, we're done. We're overdone. So here's the deal, guys. What's the significance? The significance is history. It's only significant as it is. Well, how is it? You go back to get to the future. You look backwards. You look back 6 months, 6 events, 6 to 10 maybe. But the more relevant, the more times it's happened, the more relevant it will be. So do you play a pattern, a wedge? Well, maybe. Show me how this thing behaves. Look back last 6, 12 months. That's what's going to tell me if this is significant or not. Not before. Not before. Okay. All right, Will, I love your question. He says, I'd rather have the money than get the terminology right. Exactly, buddy. You got it right. All right, guys, God bless. Have yourself a wonderful day. I hope you got something out of this. What I gave you is relevant to a lot of things, not specifically wedges, but wedges and related patterns. Hopefully this will help you out. Okay, take care. Bye-bye.